Let's talk about the markets. All right. So the first thing that comes to mind in this whole GameStop frenzy is the first hedge fund to bet against GameStop. Not one of the first ones to bet against them. They're the first ones to default, get liquidated. They're closed. They're closing. This hedge fund, London-based hedge fund, White Square, is shutting down after losing from betting against GameStop. At the peak of their they're at 440 million assets under management with losses. They wouldn't admit what their losses were, but we just know it was in the double digits percentage.
Would have to.
Other hedge funds that have lost plenty and they actually admitted to their losses. Malvern Capital, they shorted GameStop back in January. They lost more than 50% of their fund. They received a $2.75 billion investment from Point72 hedge fund and Citadel. They're still in business and they're still down year to date 44.7% as of last month, May. So that's pretty interesting to see that these guys, good for Melvin. They're bringing it back. They're trying to bring it back, but they're still down a lot and they still lost a lot of money. Another hedge fund, Light Street Hedge Fund, also down 20.1% for the year for the exact same trade. These guys still think, hey, we can short GameStop and not get hurt. There's another hedge fund a month ago or a couple weeks ago. They shorted at when GameStop was 167. Proud of it. Sent their investors letters saying we short GameStop at $167. Right now, it is at $220. It went up today 10%, and I don't see it stopping with NSC 002 coming into the mix with the automated margin calls, and more to come about that when we talk about what is happening right now in this market. So the next thing on the list is President Biden called SEC President, the Treasury Secretary, Federal Reserve Chair, all together for their first meeting. I don't know if they say that it was a routine meeting, but this is following the worst week in 8 months after the Dow Jones just took a nice, beautiful hit last week. So is it routine? Would they say it's an emergency meeting? They're saying it's a routine meeting, but I'm going to think otherwise. The other attendings were the acting director of Consumer Financial Protection Bureau, the chair of the Federal Deposit Insurance. Let's just say these are the heads of the SEC, FDIC, the options. All these guys are coming together. And this is what the White House had to say for it. They said, well, the regulators reported that the financial system is in strong condition. They further indicated that financial risks are being mitigated by robust capital and liquidity levels in the banking system and healthy household balance sheets stemming from fiscal support and the ongoing economic recovery. Now, liquidity, we know there's a lot of liquidity. We see that from the reverse repo market that just hit today at another record high of $791 billion. Yes, they have a lot of cash floating around, and guess where they're putting it? They're giving it to the Fed. The Fed is going to give them that money back tomorrow because these are overnight repos, and the Fed's also going to give them an award for that, 0.05% or 5 basis points. That's around over $370 million. Just as we get stimulus checks from the government's helping these institutions, giving them millions of dollars. Why? I don't know why. Because, well, I could take a guess. They know they are in a tough spot because we can see that the reverse repo rate, the overnight reverse repo rate, is more enticing than the 1 month treasury bill, than the 2 month treasury bill, which both of those are at 4 basis points. Then the 3 month treasury bill, that's at 5 basis points. So why would somebody wait for maturity months out when they could just get the money overnight for maturity? The government is trying to say these guys are in a tough spot. They need help. They're stepping in to help in. And yes, they are right. There is a lot of liquidity in the market. And we're going to figure out why, whether it's the easy way where they tell us or the hard way where the market crashes. And this is going to be an ongoing occurrence. And I don't believe that these reverse repo rates are going to go down anytime soon. You want to know something interesting? The last time 2008, let's say there was an emergency meeting, but they're not telling us about it. Well, the last time there was an emergency meeting was 2008, September 12th, where all these guys came together, and guess what? 6 days later, Lehman Brothers went bankrupt. The whole market went topsy-turvy. And on January 4th, 2008, they came out with an article that Bush said, the market's strong and solid. Everything's fine, people. They're not going to incite chaos and tell us that the market's shooting like blanks over here. They're not going to say they don't have ammo. They're going to say everything's fine. Liquidity's great. We all have money. The market's going to be fine. So, it's just something to think about. Let's go on to...
Here are the articles right here. Here's the one from 2008. And then right after that...
The conditions when they met in 2008, they were meeting because the market conditions had deteriorated significantly. Lehman Brothers failed after taking on tremendous amounts of debts and not really acting on them, and then wiping out in the repo market when it comes to trading between banks. So what the SEC, what Joe Biden is trying to do is Joe Biden right now is trying to have the SEC require companies to put in their financial disclosures their exposure and activities when it comes to climate change, in addition to inclusion and other cultural changes.
Financial inclusion and everything like that. So
it could have been, it may have been an emergency. I don't think it was an emergency meeting. Me personally, I think they were just meeting. And I think Joe Biden brought all these people because if you're going to make those requirements of companies, you're going to need to have all the big heads of all the regulatory bodies on board. And you're going to have to ask them, how do we do this legally? And when you think about making big changes for climate, they probably had a conversation with, we have a big plan for infrastructure. We have a big plan for addressing climate change, economy in a good spot to do it. And that's what they're saying.
Pretty fishy that it was after the first week of a very bad
week. The bad week was because the Federal Reserve Chairman Jerome Powell came out and said we expect to raise rates twice by 2023 as opposed to 2024, which is always, the markets always take a hit because inflation usually hurts equities and the entire market revalues itself. People were rearranging their portfolios. The Dow was up again, a couple hundred points today. So I think we are nowhere near the territory of market declines we would need to be, I think, for an emergency meeting of that kind. At least not yet.
We'll see what's going to happen. I would say with the reverse repos so high to record high, that is precedence to have an emergency meeting.
Well, I don't know if it's but it's an emergency though, because I think the banks are just, why would I wait 3, 6, 8 months when I could get 0.05% every single night? Don't think of it as like a systemic problem. Think of it as if you were a banker, right? And you had the opportunity to make money, and you had to park your capital outside of the bank because you don't want to hold it on your balance sheet. Well, the Fed gives you a nice place to do it, and then the Fed has that capital overnight to run operations because the Fed can use that capital and then has to give it back when these guys give back their collateral that the Fed gave them. So it could just be, this has been done before the federal funds rate window, and having liquidity right now I think makes sense when you're still talking about how much supply chain constriction there is. We don't have our labor markets back to full, and the arguments are we're still trying to tolerate a certain amount of inflation. So
yeah, I wouldn't have minded them continuing this reverse repo if they didn't just bump the reward up from 0% on June 17th to 5 basis points. I wouldn't have minded. They could park their cash wherever they want. But I don't believe that the Fed even gave us a reason as to why they even bumped them up to get awards, to get that 5 basis points.
Maybe they don't want them investing in treasuries.
Well, they, with reverse repos, they are getting treasuries. They're getting,
but they don't invest in, but they're trading. They're not like, they're not buying treasuries and holding them as assets on their books. They're trading with the Fed in a temporary.
Yeah.
Right. It's a trade. It's not, they're literally like, we'll hold this while you hold that, then we'll give it back. It's mainly
with an award.
Well, it's interest. It's not. Yeah. It's a very tiny.
They were doing that at $500 billion at these reverse repos with 0% reward. What gave them the precedence to say, hey, we're going to start giving you a 0.05% award?
Well, the Fed funds rate has this is the lowest it's ever been. Still, 0.05% is still the lowest it's been in a long time.
We're still in a recession. Did they think the economy just got better overnight and said, well, we could give money to the banks now?
Well, but when you're in a recession, you generally see more funding activity because you want to make sure there's liquidity. Because during a recession, people don't have money. So if the banks can easily make that percentage, they can backstop their deposits and they can backstop all their activity. They have more capital to use.
Well,
I will admit that I don't
apparently-
understand why
Yeah.
they're doing it at this point, but I think that's because we don't know all the information, because we don't know what the liquidity requirements are of these banks or what they're doing with less capital.
I mean, as of the meeting, the banks have a lot of liquidity on hand, so it has nothing to do with liquidity. It's something else. It could be collateral. It could be just helping them out because they're in a tough spot. But as of their meeting, the White House said, hey, the banks are fine. They have a lot of money. So we're going to see what's going to happen. News on GameStop. GameStop just completed a $5 million at-the-money share offering, raising $1.1 billion. The stock jumped up today 10%. Tomorrow, NSCC 002, the automated margin calls. It's going to be interesting to see who gets margin called first. And once we see hedge funds, just as the ones we were speaking about, closing shop, it's going to be a domino effect. And all these other guys with their failed to delivers and their over-shorted positions are going to get hit. On Friday, the Russell 1000 inclusion of GameStop, that's going to be another thing where we saw the other day the on-balance volume. No one's been selling, but yet the market, the stock has been going up and down. So we're going to see a lot of buying pressure on Friday from the inclusion on the Russell 1000. And let's take a quick look at market beat to look at the short interest data. So we can see that the short interest over time is, in January, it was up to $4.14 billion. Then they said, oh, the short's covered. There's only $842 million of short interest right now. Then it started going up February, March to 2.7 billion. And then it went down again. And now it's going up again. What is happening here? Those are called trying to cover your short positions, trying to cover your failed deliveries. And now they're getting caught. And now this recent F13, this recent report that came out for short interest from FINRA shows that there's actually more shorts to be covered, $2.66 billion. And I don't believe that's even the middle point. I think there's going to be well over $4 billion of short interest to cover.
So, I mean, all of this has been leading up to pretty much what you've been trying to predict as analyst, right? As someone like, hey, you know what, the potential of this happening because of said short interest ratios and because of how hedge funds, betted against GME, GameStop. You've been saying, we're just waiting for hedge funds to start shutting down. As soon as hedge funds start shutting down, what's going to happen next? You've been saying this for weeks now, and this is incredible that we've been able to track the development of this. And this is only just the beginning, right?
Yep, this is only just the beginning because the hedge funds are the small fish. Now the SEC has rules for defaulting parties for these institutions. And they have these wind down rules that say, hey, if everything gets defaulted, follow these rules. And now they have a new rule about the auctioning parties saying, all right, well, before we were only able to have a small group of corporations and companies and banks and everything like that to buy up these defaulted parties. So now we're going to make this rule that includes a larger party, more institutions, so that when these institutions start to default, other institutions can buy them up, because there's not going to be a government bailout this time. At least I hope not. But they're now including other institutions to buy up these companies for auction when they default.
Well, you have to understand that when the government bailed out banks. They weren't bailing out hedge funds in 2008. They were bailing out the banks that backstop them. So there wouldn't probably be bailouts because these are these are private
like
companies.
Citadel is too large to fail apparently, but if they are a party that gets taken out and defaults, there's going to have to be
Well, what
like
makes them too large to fail?
well, they have 50% well over 40% of all market traffic going through them into the market. So they control, along with Virtu.
Investing?
Yes, this is for
specific
investing.
stocks.
No, this is for all the stock market, for the United States Stock Exchange. This is why it's a duopoly. Citadel and Virtu have the majority of traffic going to those two entities, and they are choosing to either put it into the market or who knows what they want to do, but they have too much power. And it's supposed to be an easy free market, and that's why we need more competition, because those guys are the two main guys who get all the market orders and fill them.
Well, when it comes to, which is why there's a big question. We're about to go to break. This is about to end.
So let's present the question, and we'll answer it after the break. So what's the question?
Oh no, it's not a question. I was just yeah. It's not a question.
Yeah, I was trying to build up suspense. All right, guys. What we're going to do is we're going to take a little short break. If you guys have any questions, go ahead and drop them in the link. Drop them in the comments section. Let us know what we can explain what's going on. Right now, this is going to be something exciting. And so we're definitely going to come back in a few seconds. Be right back.
What you're concerned about, but I appreciate your concern.
And we're back live.
I'm very, very tired. That's why I may look very passive. But the point I was going to bring up here is that even though Citadel and Virtua control a large percentage of let's say pass through, right, for trades in the market.
Should we start the podcast?
Yeah, I started.
No, we are.
Are we live?
We're live, right?
I said we're live.
Josh, you gotta do the flailing. You gotta let us know
the verbal words were said out loud.
I don't. That doesn't work for me. I'm a visual kind of guy. I gotta see lights and sounds, audio,
there
visual.
There you go.
No, my point is, if Citadel and Virtua control a lot of the pass through for trades going into the market, do they use that in a way that hurts other companies or investors? Because when you say something has too much power, you would say, okay, if I'm the pass-through and I have a monopoly on that pass-through, then I may charge higher rates or punish other individuals, right? They may just be because there are many other of these companies. They just don't have as much traffic through them as they do. So I would ask, is there? So I guess Josh, it is a question. Is there a threat to the investors or to the brokerages that is posed by Citadel and Virtua having so much of that passed through them? Because if the argument is they shouldn't be investing in large short positions, I agree. But that alone, but just having them be big and powerful wouldn't be a reason for them to be removed, right? That would just be a consequence of market forces, unless they were using it to cause harm, to create a pricing scheme, right, or enact an undue amount of influence in their business.
So let's look at that link I just put up from qz.com.
Where'd you put it?
On it.
Do I have it?
Yep.
It's up.
So when we scroll down and we see where the majority of the volume, U.S. stock trading market share by venue,
right.
The volume's going through the NYSE, the NASDAQ, the Chicago Board, right. Citadel Securities is next. Then it's Virtu at 9.4, and then G1 Execution. Let me just tell you, they have way too much power.
Well, then would you argue that the NYSE, NASDAQ, and CBOE have too much power?
No, because they don't have an entity that trades. They're not a hedge fund. Citadel has multiple hedge funds under them, in which they have way too much market data to help them out and know where the majority of these trades are going.
Okay,
Same
but
with, and I'm not going to, say that there's market manipulation occurring, because we don't, like, from their end, that, but we can deduce that all that data can, it's like saying, hey, here's $100, there's ice cream truck there, and you gave it to a kid 5 years old. You think they're going to get ice cream? It's very tempting, but but I can't say if they're going to get ice cream or not, because I just left the house, and who knows what's going to happen until we come back and Papa SEC comes in and says, hey guys, you guys have been doing fraud. There's been a lot of market manipulation, and now we have proof. So we're going to see what's going to happen, but too much power, too much data in the hands of Citadel and Virtu. We need to diversify that amongst multiple market entities.
well, but what we're looking at on the screen here shows what 6, 9, 12, 15 of these entities.
Exactly.
So
But
what
the
you're saying is
larger
you only
percentage-
want to take Citadel and Virtua and have them broken up into multiple entities.
Yes.
Because
Because are we fighting against the NYSE? Does the New York Securities Exchange have their own hedge fund? No. Are
I don't know.
are we
don't they make ETFs? Don't they have to have somebody? Hold on.
does
I
the
wonder.
NASDAQ?
They do. They have funds, but they're like total. They have. Well, hold on. Let me see. Let me see. I'm not. I mean, okay, I understand what you're saying, but I would say that
And
that they can
and
have
there's this-
multiple business models, and then maybe one of their business models is fraudulent. Because again, it doesn't have to be the entirety of their system. There could just be people who run those couple of hedge funds that have figured out a way to play this game. But all of the broader Citadel securities, they may just be doing underwriting activities. So
do you remember? I wish I had this right with me, but I remember showing you
yeah,
the
the
trading
reverse repos.
between GameStop on this site for the month on FINRA, I believe, and it showed that the majority of trades were through Citadel and then Virtu and then other entities, and then
Yeah.
the majority of trades for April and May and March, and the majority of trades for GameStop were through Citadel and Virtu. They didn't say NYSE. They didn't say anything. That would have been a better example for me to prove my point that the majority of trades that are being placed into the market is by those entities.
Well, through those entities.
Yes, through those
Right.
entities.
So that's why Citadel wanted to be a primary dealer, because they wanted to basically be in every part of the market. So, I mean, I agree that you might want to separate them, but you'd have to prove that they were using that data for that reason. Like, I definitely think there was some sketchy behavior there with using their repos and the potential to have that capital on their books. But just as a pass-through entity, I don't think leaving Citadel but that percentage would be a bad thing. I think maybe you would want to spin off the hedge funds, perhaps maybe separate them, just like you do separating banking and other certain industries. So you force them to only focus on one silo of operation. I could definitely see that. But I wouldn't say you'd break up Citadel and make two different venues that do the same thing, because that part of Citadel might be valid.
No. We don't want to just break up Citadel and make them two different entities. I want to make sure that there are hundreds of broker dealers out there that are able to fill to the market. I don't want just one and then say, oh, there's another one, so it's fine. No, I want hundreds, because we need to make this a level playing field. We don't need to keep seeing this pay for order flow. We don't need to keep seeing all these ways that they can use this market data. We need an efficient market. And the first step to doing that, along with all these other SEC rules that have been coming out, a very big step would be diversifying the power of who gets to put the orders into the actual market. It would make our bid-ask spreads much, much lower, and we'd be able to get filled at way better prices.
Sounds
Maybe.
good.
Maybe.
Sounds good. Was that your last topic for today?
Yep, that was the last topic for
So then for
market.
people who are just jumping on, GME up 10%, do we see this as the end or beginning of this rise?
Oh, it's begun since January. I've been looking and following this whole thing, and it's barely in the middle, and it's just about to begin. I'm predicting that it's going to start hiking up. 220 is just the beginning. It's already had, 3 run-ups and fallback downs. The ETF, which there's an ETF over here, XRT. I remember talking about it, and I'm gonna put it up for you. XRT. I remember last week, and I'll put the link right there. Okay. Last week we saw XRT. It was shorted at 160%. Then we saw it go and it got shorted down. Shorted at up a percentage to 180%. Now it's shorted 218.53%. How is this still happening? How is XRT, which is the retail sector, retail ETF, still being shorted?
I have no idea.
It's like they're not stopping, and they're just trying to get their last breath in before all these rules finally start, like tomorrow. And when 005 finally gets fully in effect, everything is going to start coming full circle, and we're going to know who has the actual shares and who are the borrowers of these shares.
So tomorrow's a big day.
Naked shorting is hopefully going to cease, and we're going to see more data. So if we don't see it this week, just know that within the next month, it's going to be a bloodbath, and we're going to see how much GME is actually shorted. What is the actual short interest in this stock? And let me say, it is well over, from my perspective, well over 140%, because the only reason they ever say, well, it's short 140%, that's because the SEC actually capped them off from putting in the document that you can short that 140%. Anything over, you can't say in the documentation that it's short over 140%. They capped it off at 140. I'm thinking that it's well above 140. I'm thinking that it's in over 200% shorted.
Why did the SEC cap it at 140?
They probably thought, well, 140 is a large amount to short a stock. If anything more, people might find this and say, hey, we're going to take the opposite trade and push those shorts out the door, out the house. But they didn't even want...
But if the SEC, think of it this way, right? The SEC passes a rule and you're not allowed to be more than 100% short of a company. So why does the SEC say you're not allowed to report more than 140%? Why does it even allow it in the first place?
Exactly. They shouldn't have allowed it in the first place. They're too lackadaisical with their rules. And we thought we learned from 2008. Why didn't we bring up these rules that we're finally getting in 2021 back in 2008 and afterwards? Because we knew naked shorting was illegal. And they knew it was illegal. And that's why they said, we're stopping the practice. Guess what? It's still been going on. We're finally getting the rules that we have needed in this whole game of financial markets. Because let me tell you, it is a game that they're playing. And they play it at a high frequency trading game. And they make all the money and they mess up the whole institutional foundation for retail. Do you even believe that have you believed we're on a level playing ground with these institutions?
No, obviously not.
Never. No. But this is going to bring the playing field that much more closer to a level playing field. And, as Michael Burry said, people are asking him, hey, what's happening in the financial markets? He just says, the largest financial crisis we have ever seen is occurring right now. Larger than 2008. We thought we couldn't get as bad as 2008. No, it's worse. And we're going to see it all across the board. Commercial real estate market, who knows if hopefully the retail market doesn't get hit again. But let me tell you, if the banks go down, everyone goes down. So it's all across the board. We're gonna see a lot of pain.
This is what you've been talking about for weeks and months on end. This was one of the biggest driving factors of creating this podcast. There's so much news. Ooh, that was a little weird. Nice. Air come out. There's been so much news around this, and all of this is, let's be honest, this isn't in the public eye. This is kind of like your guys' ability to view this news and interpret it in a way that's going to reflect what Jeremy said is, it's not the repeat of the past, it's the rhyme of the past.
Yeah, history doesn't repeat itself, it rhymes. But at the same time, it's only been 13 years since 2008, and it's repeating. That's why, I mean, I've been trying to see when the market's going to crash, why it knows everything's overinflated, everything has such a high valuation. It's unsustainable. And we've been waiting for this market crash, and COVID has accelerated it. And these Redditors, these people who are backing GME because of these naked shorts and the fraud, everything is coming together. Even the commercial real estate sector, with people saying, "Oh, your business, you want this building, you want this business building? How much do you make? Oh, 100K revenue. Well, just say on your sheet that you make $1 million revenue, and then you can have this business." When that goes topsy-turvy, belly up, there's going to be a lot of foreclosures in the commercial sector.
Man, exciting news. Any thoughts or predictions on what might happen next? I see this all as a domino effect. One thing's coming after the other. What's going to be that next block hit?
Hedge funds.
So that's where that first hedge fund shutting down was so exciting.
Yeah, and it's just the beginning. And in the news article they said, well, they lost a lot of money, and then their two largest investors, they backed out, and that's why they are closing. And then they're going to reevaluate and see if they could open up again. But they lost a lot of money. Then these next couple days, I'm telling you, tomorrow's a very exciting day with this automated margin call system. I don't think you guys understand that they're going to do liquidity checks right then and there. You want to know something interesting? Now in the options market, for these institutions, when they hold options, they need to prove liquidity 2 days before, lock up their cash 2 days before for their options positions. Then they on options day, that's a very important day. 7 days after, they still have that cash locked up. So they're in a world of pain. Now they have to really think about, okay, for these options positions, we have to have the cash on hand in order for us not to get liquidated. That's a new rule that came out. And level playing field. We're gonna see a lot of chaos in the market, and I'm pretty excited about it.
So for anybody who is wondering what it means to have liquidity when you're making your options, or when you're is it calls for options? What's the proper terminology?
Options are
when you're making
derivative
options.
Product,
mm-hmm.
And a derivative for one contract for a call option is worth 100 shares of a stock. And you're looking at, let's say you have Apple. You have Apple at $100. So you buy a call option at the money for $100, and you're betting that it's going to go up. So this call option is going to go up, and it could be for a week maturity, it could be a month maturity, it could be a year maturity. Depending on the maturity rate, the length of the contract, it's going to go up in price. There are these Greeks in there, and we could go into that later for more financial segments, but they get pretty complex. And usually options is a losing game, because the longer you hold that contract, the less value it has. So you need to be smart about it. You need to look at volatility. You need to look at the time maturity, and there's just a lot happening. But what I'm waiting to see in this whole GME is when another gamma squeeze occurs. And that's going to be the first thing. It's not going to be a short squeeze right away. It's going to be a gamma squeeze. And that's when these market makers need to buy up more shares, because the stock price goes up from $100, and let's say you have 1,000 options, call options at $105. Well, once the price goes from $100 to $105, you got 1,000 contracts now in the money. Well, guess what? Per one contract, that market maker now has to buy up shares in order to keep both sides of that trade neutral. So they're not over leveraged. So the market makers now need to buy up these shares in the market, increasing that price. And so it's going to be, and that's what's called a gamma squeeze. When that occurs, and let's say 20,000 contracts become in the money, the market maker needs to quickly become delta neutral, buying up more shares from the market, and it's just going to skyrocket up, and then boom, 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 and you're just going to see it hike. There's a lot of strategies in this market. There's a lot of rules, and we're going to see GameStop. I don't doubt they're going to try any more manipulation. I hope, these rules stick and help us out, but I don't doubt it's going to go up.
That's great news. We will be intently waiting to see the result on how all this is going to play out. Thank you so much for the analysis.